Welcome to the Wealth Studying Podcast. This is episode 493. Today is September 15th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Hey, today I want to talk small cap stocks. With the inevitable lowering of interest rates, the herd mentality is that everybody's pouring into small cap stocks. Listen, I don't hate small cap stocks, but I'm telling you, if you're going to invest in them, don't do it willy-nilly. Because when it comes to small cap stocks, you need to beware of the zombie unprofitable companies. That's what we're going to talk about in today's episode. Okay, definition-wise, for those of you that aren't familiar with what constitutes a small cap stock, it's generally a company that has a market capitalization somewhere roughly under $2 billion. That's constantly a changing target because obviously with inflation and with appreciating stock prices, that means smaller cap stocks are constantly getting larger, and so we have to raise the ceiling of their market cap to, encapsulate those small companies. Something to think about too in the big scheme of market capitalization is that if you look at the small cap stocks, we talk of them being the Russell 2000. There's actually less than 2,000 stocks on the Russell 2000. But if you added up all their market capitalization, it comes out to maybe 2 to 3 trillion. To put that in perspective, all of those nearly 2,000 companies, their entire market cap is less than one individual company like an Nvidia or a Microsoft or an Apple or a Google or even an Amazon. So just to give you some idea of how large the large cap stocks are and how small the small cap stocks are. And yet, to put that in perspective, and this will be the topic of another episode down the road someday, I've got a whole list of things I need to talk about. But as small as our small cap stocks are in terms of total market capitalization, they're about equal in size to the entire market cap of, say, the FTSE 100, which is effectively Britain's S&P 500, and other markets of countries of large size, say France or Germany, keeping in mind that Germany is, I think currently is back to being number 3 in terms of overall global economy. Our small cap Russell 2000 is as big or larger than, France's CAC 40 or German's DAX. Even if you look at the Eurozone as a whole, I think the Euro 50, the stocks, which, comparatively, that's like, again, America's maybe Dow Jones Industrial Average, I guess you look at it that way. That's only about 4 trillion. So as small as our small cap index is, it's still substantial in terms of the global marketplace. And again, I'll get to this in future episodes, but that's why when you hear people say that you have to diversify and you have to invest outside of the U.S., maybe not. There's a lot of reasons for why simply investing in the United States gives you plenty of international exposure. Back to the small caps. And I'm going to take the other side of the argument now because for as much as I'm saying, you get diversification by owning these nearly 2,000 stocks and they're equivalent or maybe larger than some of the entire other country indexes, they actually don't offer a great deal of diversification, especially when you factor in that, again, it's nearly 2,000 companies, but they are focused in such a narrow sector range. For example, you have probably 40% or close to 40% of the index just being in financials and industrials. And as much as I love industrials, especially over recent years, a lot of these tend to be industrial companies with not that great of a growth rate, especially when you factor in how small they are and that associated risk factor. And even worse is when you do look at those financial companies, and again, they've done better recently because people are thinking there'll be a lot of bank deregulation, and of course with the lower interest rates, that's supposedly going to favor these financial companies. But in a lot of ways, we've been hearing that since the 2008 financial crisis, and overall, I think it's pretty safe to say that financials have not been best of class performers over the last 15, 17 years, and certainly not the smaller cap financials. I mean, some of them are fine. I'm definitely looking at some of the regional banks, which I think with potential deregulation could be either acquisition targets, or they could merge to form larger banks, so that is of interest to me. And I do think in terms of these regional banks, going forward is probably the best, growth opportunities they've had in 15 or more years. But having said that, take a step back and think where these small regional banks generally have most of their revenue. It's in real estate, and specifically, it's in brick and mortar retail or office space. To me, that's concerning. Now, the story on small caps gets even worse because when you get outside of the two largest sectors, the financials and the industrials, that's pretty much where the profits end. And what I mean by that is that around 38% of companies in the Russell 2000 are unprofitable. And not only unprofitable, but the vast majority of that nearly 40% that are unprofitable have never been profitable. And the biggest sector of that happens to be, about the third largest sector within the index, and that's generally the healthcare, but more specifically the pharmaceutical and biotech companies. Now, these are the companies that are famous for, pump and dumps. You'll hear promoters all the time talking about, this is the latest cure for cancer, or it's in final round of FDA approval. Well, keep in mind that smaller biotech pharmaceutical companies, something like in excess of 90% of them fail. Now, that's not a direct number to the Russell 2000 because in order to get into the Russell 2000, there is some, discriminatory filtering where the weakest of companies don't get into it. But I know that it's definitely been increasing, especially post-pandemic, when a lot of that biotech and, vaccine type money is drying up. And when you look at that overall, 38% of unprofitable companies that make up the Russell 2000, those numbers are predominantly biotech and pharmaceutical companies that are losing money. And I've seen estimates that say as many as 80% of these small cap biotech are not profitable. And again, they've never been profitable. Look at a company like Moderna. You remember them from the pandemic hysteria. Their COVID vaccine, I believe, was the first product they ever had that not even necessarily was profitable, but was commercializable, right? They never even had revenue for like their first 10 years of existence until that vaccine came out. And then moving further down the Russell 2000, the next biggest category is generally what's just labeled as tech. And the problem with this, again, it's the companies that are very susceptible to the pump and dump schemes. Anytime there's a new technology, and you can think back to the dot-com bubble, companies will just throw .com in their name, even though they had no profits, nothing to sell, and they were hyped about taking advantage of the next technological leap. And, you still see that today. The companies that throw crypto in their name or throw AI somewhere in their title or their ticker symbol, well, those companies make up a large percentage of those unprofitable companies as well. And so I'm just trying to reiterate here, I'm not saying avoid small cap stocks. I've owned the indices before. If you remember back during the pandemic, my COVID-19 portfolio, I actually owned a lot of small cap stocks. The reason for that was, effectively though, back then, the Federal Reserve pretty much carte blanche said they're not going to let anybody go bankrupt. So I thought that mitigated a lot of risk. I also recommend small cap stocks for people to own, say in their 401k portfolio, where they have very limited, 5 or 6 mutual funds to choose from. And these pump and dump schemes that are really characteristic of these small cap companies, they're not limited to just names you've never heard of. I mean, think of a lot of the things that come out of Cathie Wood's mouth. It's going to the moon. It's going to double by the end of the year. Yeah, look how things like CRISPR have worked out. And again, not that gene splicing technology isn't going to be all the thing someday, but you don't want to invest your life savings of $1,000 in one of these companies just because you hear a tip from some influencer or somebody on, the major networks talking about a sure thing, because nothing is a sure thing. CRISPR is a perfect example. They've never been profitable. I don't think they have any current path to profitability. But during the pandemic and the meme stock hysteria, that stock had its price talked up to be something like, $180, $190 a share. Today it's trading for around $55. And it wasn't just the run up through the pandemic years. I mean, really, if you've owned that stock since, I don't know, probably 2018, you probably haven't made any money. A more timely to today's market conditions is all the hysteria about nuclear energy. Now let's step back a minute. If you've listened to my episodes, you know I'm a big believer in nuclear energy, and I'm an even bigger believer in the overall electrification trade. But I'm still very selective in where I invest. Oh, and let me digress a second here too. Check today's show notes. I've got a link to a podcast episode that I recorded last week. I was with my friend Jack Spirko on the Survival Podcast. We were joined by a friend of ours, Dylan Allen. He's an expert in the nuclear industry, and I don't mean expert in air quotes, but I mean a real expert. He's got the education and credentials and work experience, everything from a nuclear officer in the Navy to being the president of an industrial nuclear company today. So he's the real deal. If you want to get an understanding of the current state of nuclear power and its potential, and things like small-scale nuclear reactors and thorium reactors and all those new and emerging technologies, definitely check out the show notes and follow that link, because that episode has a wealth of knowledge in it. In any case, to that end, a very popular company right now is NuScale Power. They're a small-scale nuclear reactor company. They're all the rage. Again, Dylan will talk about this if you listen to that podcast interview. But I'm going to give you a little spoiler alert specifically on these small-scale nuclear reactors as far as my perspective as an investor. I don't want to be on the bleeding edge of technology. NuScale, I think, is one of these companies, like CRISPR. It's not that they're a scam, or it's not that they may not have the best nuclear reactor since sliced bread someday, but they don't have it today. And that stock is incredibly volatile. So I'm not saying that you shouldn't own it. I'm just telling you I don't own it. I own plenty of electrification and nuclear energy type stocks. But again, I want companies that are either profitable or have a likely path to profitability, not just a story about how they're going to be profitable. And you've heard me now just talking mostly about small cap, more or less tech type companies. But it's not just where you get these crazy price run-ups in zombie small cap companies. Think about Peloton. That's another small cap, zombie type meme company that got its price bid up, I think, close to $200 at one point, something like that. It's currently trading at about $8. Bottom line is, it's an exercise bike company. So be careful. And again, this is not to say that I don't own or wouldn't own a small cap index or individual small cap companies. I do. I'm just very cautious. If you look at my overall portfolio, I own some close to 140 stocks. Maybe 10% of that at best is invested not in just small cap companies, but really mid-sized to small companies. So maybe 10% of my portfolio is invested in companies that have a market capitalization of less than $10 billion. And probably non-coincidentally, in that category is my current worst performing company, as well as, on the other end of the spectrum, my best performing company. And as you've heard me talk about in previous episodes, I don't care so much about the losers. I'm mitigating my risk through diversification and good, solid fundamental investing. And the losers can only go to zero, right? Your losers have limited downside, but your winning stocks are uncapped. Their gains can be infinite. As an example, probably my worst performing stock right now is a small cap company, really a micro cap company. It's a local Utah company. It's called Health Catalyst. I think they do have a great deal of potential. But so far, their potential isn't anywhere in sight. I've lost probably over 60% of my initial investment in that company. Now, it's a small sliver of my overall portfolio. I never like to lose money. But again, if you're mitigating risk, and then you look at that other small cap company I own, Centrus Energy, this gets back to the nuclear electrification trade. Centrus Energy refines uranium. They not only refine uranium, but they're really the only privately held, and more importantly, U.S.-based company that's even in that industry. And they're up right now something like over 450%. Now, that could change tomorrow because they're highly volatile. But again, I have a small part of my overall portfolio that I invested in that company. It's one of 140 stocks. And the gains that it has generated are astronomical, and they overshadow virtually all of my combined losses from all my losing positions. You're generally not going to get that kind of growth out of a large cap company, but at the same time, remember all those losers I said that are in the small cap stocks. Yeah, I want to own a few of the real speculative ones, but only to a small degree, because that's where the risk is. The risk is generally in the smaller companies. And so if you're looking to invest in small cap companies, especially if you're going to use an index or a mutual fund or an ETF, look for one that screens for profitability. You'll find that in an ETF like SPSM. That tracks the small cap 600 index, so it's not the Russell 2000, it's the small cap 600. It consists of small cap stocks, but they're all profitable. And better than that, I really like the mid-cap companies. I really think that's a sweet spot. So take a look at an ETF called MDY. That's the S&P Mid-Cap 400. Again, not only mid-cap companies, but focusing on those mid-cap companies that are profitable. And what I like about mid-cap companies over small-cap companies is that I think the risk-reward is so much better. You do tend to have more profitable, stable companies in the mid-caps because they are larger, but they're also tending to have growth rates where they either end up merging with other companies or they get bought out, by the big mega caps. And I guess ultimately that's the biggest problem, besides the unprofitable nature of the small caps, is that by definition, the small cap indice always remains small, right? The magic of the S&P 500, and this gets back to that losses are limited and gains are infinite. The magic of the S&P 500 is that they're constantly getting rid of the losing companies or the slow growers, and they're replaced with the profitable, higher growth companies. And that's almost exactly the opposite of the small cap index. Oh yeah, the small cap index always has new entries coming into it, but they all tend to be risky, many or most of them unprofitable, and to the extent that they do become profitable, then they get promoted and move into the mid caps or into the S&P 500. So in a lot of ways, you can look at the small cap indice as really having perpetual risk and never as much upside. Again, because those winners are always going to get promoted to somewhere else. Well, hey, just my contrarian view. Until next time, as always, this is John Pugliano wishing you the very best returns.